Hi everyone and welcome to my first insightful episode from Beta G Dynamics, where I bring you deep analysis and strategic insight to help you navigate the complex world of cryptocurrency. Today I'm diving into the fascinating topic, the Hamster Kombat Enigma, exploring trust in the high-stakes digital world. As you know, in the fast-evolving crypto market, understanding the potential risk and strategic dynamics is important for everyone involved, whether you are investor, trader, or enthusiast. In this video, I'll explore the hypothetical scenario, Hamster Kombat, using game theory as a method to analyze how fraud risks can emerge in a crypto market setting. As you know, game theory allows us to model and predict the behavior of different players in the markets, from central entities like Hamster to users, investors, exchanges, and regulators. In fact, by understanding these interactions between different players, we can uncover the potential incentives and risks that might lead to prominent crypto entity to engage in fraudulent behavior, and how such actions could impact everyone involved. To be more specific, our goal today is to provide you with a deeper understanding of the strategic decisions that can influence the stability and integrity of cryptocurrency platform. This knowledge will empower you to make more informed decisions in the markets and helping you identify potential red flags and avoid possible pitfalls. However, it is important to remember that while I strive to provide accurate and valuable insights, all investment decisions are ultimately your responsibility. The crypto market is highly volatile, and this video should not be considered as financial advice. Always do your own research and consult with the financial advisors if necessary. With that said, let's dive into a Hamster Kombat scenario and see what game theory can reveal about the risk in the world of cryptocurrency. In this video, where I'll explore a puzzling and controversial issue in the world of cryptocurrency, imagine a platform with about 300 million users, backed by some of the most prominent investors and exchanges. It's names that recognized and trusted by millions around the globe. But what if seemingly reputable entity was accused of being a scam? How could something so big, with much support, turn out to be fraudulent? How is it possible? In fact, this is a dilemma I'm going to dissect using the lens of game theory. In this video, I'll explore the potential dynamics at play, the incentives for different stakeholders, and how, despite appearance, even the most trusted platform could have underlying risks. The core question that I will address is, how is it possible that Hamster, with the massive user base and a strong backing, could scam its users? It is not just a hypothetical situation. Understanding the scenario can give us valuable insights into how scams can occur even in seemingly safe environment, and how you as an investor or users can protect yourselves. So, let's dive in and unravel this mystery using the game theory to shed light on a strategy's risk and decision that could lead to such an outcome. Now that we have set the stage, let's define the scenario we are dealing with. As you can see, we have two different scenarios. First, let's talk about the Hamster. Hamster is not just any platforms. In fact, it's a major player in the cryptocurrency world with about 300 million users. It's built a reputation as a trusted entity, supported by high-profile investors and partners with some of the biggest exchanges out there. And on the surface, everything about Hamster screams legitimacy and trust. But here were the plot thickens. What if Hamster, despite its seemingly impeccable credentials, were involved in a scam? In fact, by a scam, we mean a situation where Hamster might engage in the fraudulent activities or mismanage its operations in a way that leads to severe financial losses for the users. This could involve anything from misleading information to misappropriation of the funds, so sudden closures they leave investors high and dry. In this scenario, we are not just talking about a small time fraud, we are looking at the possibilities. In fact, we are looking at the possibility of the large scale betrayal by an entity that's deeply embedded in the crypto ecosystem. The implications of such situation would be devastating not just for individual investors but for the entire markets. The next part of the video, we will use the game theory to dissect this scenario and exploring how such a respected entities could potentially take a dark turns and what strategic factors could lead to shocking outcome. Now that we have defined the scenario, let's dive into heart of our analysis using the game theory. To understand how a situation like the one we have described could unfold, we need to identify the key players involved and their potential motivations. In the scenario, we have 5 critical players. The first one is Hamster Kombat. This is a central entity and the major players in the cryptocurrency space. Hamster controls the platform, sets the rules, and interacts with all other stakeholders. And their decisions and actions are at the core of this analysis. And accordingly, the first player incentives are profit maximizations, reputation management, control and power, and finally survival. First, the profit maximizations. The first incentives of Hamster. As a central entity, Hamster's primary goal to maximize profit. This can involve attracting more users, increasing transaction volumes, and enhancing the platform's value. The next incentives for Hamster is reputation management. Hamster has a strong incentive to maintain its reputations, to keep user, investors, and exchange engaged. A good reputation ensures long-term success and growth. The incentives number 3 is control and power. Hamster might seek to maximize its control over the ecosystem, influencing how users interact with the platform and how much information is disclosed to public and regulators. And final incentives is survival. It is a competitive market. So in the competitive market, Hamster is incentivized to survive and thrive, which could lead to taking risks and either ethical or unethical to stay ahead. After Hamster, we arrive to the second player in the markets, users or end consumers. These are the end users or end consumers who have invested their money and trust in the Hamster. They are the ones most directly impacted by any positive or negative actions that are taken by Hamsters. These players' incentives are security and trust, profit and returns, and transparency and ease of the use. Let's start to explain the first incentives for second players, security and trust. Users want to ensure that their investments are secure and that they can trust the platforms. In fact, they are incentivized to use the platform that have a strong security measures and trustworthy reputations. The next incentives is profit and returns. Users are motivated by the potential returns on their investments. They are likely to stay engaged with Hamster if they believe it will provide good financial returns. The incentives number 3 is a transparency, where users desire to transparency from Hamster to ensure they are not being misled or exposed to unnecessary risk. And finally is ease of use. Convenience and a user-friendly interface are also important incentives, as users prefer platforms that make it easy to trade, invest, and manage their assets. After the incentives introductions for second player users, we are at the third players, investors. In fact, investors are financial backers that have put significant resources into hamsters and expecting returns and growth. In fact, they have a vested interest in the platform's success, but also in safeguarding their investments against the potential risk. These player incentives are return and profits, and the most important incentives is ROI or return on investment, risk management, influence, and control market positioning. Let's start with the first incentives, ROI or return on investments. Hamster investors are primarily driven by the need to see a significant returns on their investment, so they support hamster to grow their capital and generate profits. The second incentive is risk management. While investors want high returns, they are also incentivized to manage risks, and they need to assess whether hamster is a safe and profitable venture or not. The third incentives for investors are influence and control. Large investors may seek influence over hamster decisions to protect their investments and ensure the company actions align with their financial goals. And final incentives for investor are market positioning. Investors are incentives to back companies that position themselves strongly in the market, which can lead to greater profit and long-term stability. And finally, we have exchanges at the number 4 as a player number 4, exchanges or trading platforms. That these are the trading platforms that list hamster tokens or products, and their reputation is tied to legitimacy and performance of the assets they trade, and making them important stakeholders in these scenarios. And these players' incentives are trading volume, reputation and trust, security and compliance, and finally market share. Let's start with the first incentives of exchange, trading volumes. In fact, exchanges are motivated by high trading volumes as they earn fees on transactions, and listing popular or high demand assets like hamster token can drive more users to their platforms. The next incentives for exchange are reputation and trust. Exchanges must maintain a strong reputation to attract the users. Associating with the credible and trustworthy entities like Hamster is crucial for their business. Security and compliance is the next incentives for exchange, and exchange are generally incentives to list assets that comply with regulations and don't pose significant risk, as any association with scams could damage their reputation and lead to large consequences. And finally, we have market share as a final incentives for exchange. And competing with other exchanges, they are driven to list prominent assets to attract and retain users. Enhancing their market shares is in fact the final incentives for exchange. Okay, we are in the final stations of the players' introductions. Regulators. We have the oversight bodies responsible for ensuring that everything operates within the law. So law with a special importance in this game and in these players. As we know, regulators have a power to enforce rules and impose penalties and protect customers from frauds, and these players' incentives are market integrity, consumer protections, compliance enforcement, and public trust. So let's start with the first incentive, market integrity. Regulators are motivated to maintain the integrity of the financial markets and ensuring that platforms like Hamster operate fairly and transparency. The next incentives are customer or consumer protections. In fact, the primary role is to protect consumers from the fraud, scams, and unethical practices. And regulators are incentivized to detect and prevent any activities that could harm users. The third incentives for regulators is compliance enforcements, where regulators enforce compliance with laws and regulations to ensure that companies operate within the legal boundaries. and they are driven to penalize non-compliance to deter others. And final incentives is public trust, that maintaining public trust in the financial system is important, so regulators work to ensure that entities like Hamster don't engage in practices that could undermine confidence in the markets. In this game theory analysis, we will explore how interactions, strategies, and decisions of these five key players with their incentives could lead to different outcomes, and ranging from the continued success to the potential unraveling of the scams. In fact, understanding the roles and incentives of each player is important to unraveling how a trusted entity like Hamsters could potentially engage in the fraudulent activity, or in fact, what is the possibility of scams in this case, and what safeguards or red flags might exist to prevent or detect such behavior. Now that we've identified the key players and their incentives, let's explore the possible strategies that each player might employ in the scenarios. Understanding these strategies is very important to predicting how events might unfold, especially in the situation where trust and reputations are at stake. Let's start with the first players, Hamster Kombat. The Hamster entity have two different options in the strategies. First is honest operations. Hamster could choose a maintaining transparency and integrity, operating honesty to continuing building trust with user, investors, exchanges, and regulators. In fact, by being transparent and adhering to ethical practices, Hamster can ensure long-term success and growth. The next strategy or scenario is fraudulent operations. Alternatively, Hamster might engage in deceptive practices such as misrepresenting the value or functionality of the platforms. That these strategies could be motivated by short-term gains but comes with a significant risk, and including potential collapse if the fraud is uncovered. Second players is users, as we know, and we want to know what are the possible scenarios for user strategies. Users have two different strategies in their own. The first strategy is trust. User could choose to continue using the platforms and trusting that it is legitimate, and this strategy is based on the assumptions that Hamster reputations and backing by prominent entities mean that the platforms is secure and trustworthy. And the second strategy is withdraw. On the other hand, if users suspect fraud or mismanagement, they might choose to withdraw their funds and exit the platforms. And this strategy is protective measures to avoid potential losses, but it could also contribute to loss of confidence in Hamster. Player number 3 are investors. As we know, investors are the peoples that have important roles in these games, and they have two different strategies also, support and divest. Let's start with the supports. Investors may decide to continue supporting Hamsters and believing in its growth potential and assuming that the platform value will increase. This strategy is driven by expectation of high returns and confidence in Hamsters' operations. The next strategy is divest, where investors detect signs of fraudulent behaviors. In fact, if investor detects these signs, they might choose to withdraw their investments. And divesting is a strategy to protect their capitals and minimize potential losses, but it could also trigger a loss of confidence and a decline in the platform's value. In continuing the different players and their strategies, we arrive to the exchanges. Exchanges have two different strategies, listing and the list. Let's start with listing. Exchange could choose to support Hamster by listing its tokens, thereby providing liquidity and access to the broader markets, and this strategy assumes that Hamster is a valuable asset that will attract traders and increase trading volume on the exchange. The next strategy is the list. However, if exchange detect fraudulent behavior or believe that Hamster poses a risk to their reputations, they might decide to delist the platform tokens. And the listing is a defensive strategy to protect the exchange credibility and avoid association with potential scams. And final players, regulators, have two different strategies: monitor and intervene. In monitor strategies, regulators might choose to monitor Hamster closely, ensuring that it complies with all relevant laws and regulations, and this strategy involves regular oversights and enforcement of standards to maintain market integrity. In intervening strategies, if regulators detect fraud or legal violations, they could intervene by taking action against hamsters. They could involve fines, sanctions, or even shutting down the platforms to protect consumers and maintain confidence in the financial systems. Okay, this strategy highlights the different paths for each player could take, depending on their perceptions, incentives, and the information available to them. As we continue, we will explore how these strategies interact and what potential outcomes could emerge in the complex scenario. Now that we have explored the possible strategies for each key player in the Hamster scenario, it's a time to analyze the potential outcome using the payoff matrices. Payoff matrices help us visualize the possible consequences of different strategies by showing the reward or risk in relation with each choice. Now that we have outlined the strategies for each key player in the Hamster scenario, let's analyze the outcomes using update payoff matrices. These matrices help us visualize the reward and risk associated with each player's choices. First, let's start with payoff matrix for Hamster Kombat entity. Let's start with the Hamster Kombat entity's payoff matrices. Hamster has two main strategies: maintaining transparency and integrity, or engaging in deceptive practices, and the outcomes depending on the user behavior. As you can see, user trust and honest operations have important roles here for Hamster Kombat entity payoff matrix. Let's start with user trust and honest operations. If Hamster maintaining transparency and user trust the platform, it will enjoy high long-term values, and a strong reputation leads to sustainable growth and loyal user base. The next is user trust and fraudulent operations. If Hamster engage in deception but users continue to trust it, there may be short-term gains. However, this strategy poses significant long-term risk. Once the fraud is uncovered, it can result in the major loss of reputation and value. The next is when user withdraw and honest operations. If user withdraw despite Hamster honest operations, the platform might have a smaller but stable user base. Growth may be slower, but it avoids the severe risk of fraud. And finally, when user withdraw and there is a fraudulent operations. If user withdraw and Hamster is fraudulent, the platform might experience immediate gains from those still invested. However, once the fraud is exposed, it will lead to the substantial loss of user base and potential collapse. Okay, let's start the next payoff matrix with together. The payoff matrix for investors. Let's consider the payoff matrix for investors, and investors can either support Hamster Kombat or divest based on their perceptions of platform honesty. As you can see here, there are two strategies for investors: support and divest. When there is a support and honest operations are crossed with together, we have positive return on investment. If investors continue to support Hamster while it operates as honesty, in fact, they are likely to see positive return on investments. And as the platform success translates into financial gains take place. The next possible conditions when there is a support take place with fraudulent operations. If investors support Hamster despite its fraudulent activities, in fact, they may be experience high short-term gains. However, this comes with the risk of significant losses if the fraud is revealed and platform collapses. The condition number 3, when there is a divest take place with honest operations. At here, this part of the matrix. This is the conditions that if investors choose to divest from Hamster while it operates honestly, they forego future gains. So they miss out on the potential growth and return from the successful, honest platform. And final condition take place when divest and fraudulent operation take place here. If investors, in fact, divest for suspected fraud, they avoid significant losses. While they miss out on short-term gains, they protect themselves from potential major losses if fraud is exposed. Okay. In the next part, we examine the payoff matrix for exchanges. And exchanges could choose to list or delist Hamster tokens based on the platform's operational strategies. As you can see, there are two different scenarios for exchanges: listing and delisting. Listing and honest operations is the first conditions that take place in the matrix for exchanges, payoff matrix for exchanges. In fact, if exchanges list Hamster tokens and the platform operates honestly, they benefit from increased fees and trading volumes. A successful and transparent platform attracts more users, boosting the exchange revenues. The second condition takes place when listing and fraudulent operation cross each other. If exchange lists Hamster tokens while it's exchanging the fraud, they might enjoy short-term fees from increased trading. However, this exposes them to significant risks, including potential legal issues and reputation damage if the fraud is uncovered. The third condition takes place when the listing and honest operation cross each other. When there is the listing take place with the honest operation. If exchanges choose to delist Hamster despite these honest operations, they lose out on the potential fees and trading volumes, and additionally they may face negative publicity for removing illegitimate assets. And finally, when the listing cross fraudulent operations take place when exchanges detect fraud and decide to list hamsters, and they avoid legal and reputational damage associated with the fraudulent platforms. While they miss out on short-term gains, they protect their long-term credibility. Okay, after payoff matrix for exchange explanations, this is a time to explain the payoff matrix for users. We will start with the users, and their strategies revolve around the continuing to use the platforms or withdraw their funds. The payoff they experience will depend on whether hamsters operate honestly or engage in fraudulent activities. As you can see also in the payoff matrices for users, we have two different strategies, trust and withdrawal. The first conditions take place when trust is crossed honest operations. Here, if user decide to trust Hamster and it operates honestly, they are likely to enjoy safe investment and potential gains, and this trust is rewarded as the platform grows and provided returns. The next condition take place when trust and fraudulent operations are cross each other. If user trusts Hamster while it engage in fraud, they face potential losses. Once the fraud is discovered, it leads to decreased trust in Hamster and possibly other similar platforms and damage their overall investment confidence. The condition number third is when withdrawal cross honest operations, and it's take place when withdrawal from Hamster despite its honest operations, and users withdraw their monies and they miss out of potential gains in these conditions. However, the users in this condition reduce their exposure to risk, especially if they are concerned about the volatility or external factors. And final conditions for user payoff matrix is where withdrawal cross fraudulent operations. If users withdraw because they suspect fraud, they avoid potential losses, and this strategy helps them protect their assets, and their early withdrawal might serve as a warning to others and potentially minimize overall damage. Okay, final payoff matrices belong to regulators, and their strategies include monitor the platforms or intervening if they detect any issues. The payoffs are influenced by whether Hamster operate with the legal boundaries or engage in fraudulent activities. In the payoff matrix for regulators, we have also four different cross when the monitors cross honest operations. If regulators choose to monitor hamsters and the platform operates honestly, this leads to market stability and maintain public confidence, and regulators effectively oversee the market without unnecessary interference. The second condition takes place when monitor cross the fraudulent operations. And this is the conditions if regulator only monitor while hamster engage in the fraud, their delayed actions could result in reputational risk, and the public might lose confidence in regulators' ability to protect them, and the markets could suffer if the fraud is not promptly addressed. In the third conditions, we are where when intervene cross honest operations, and if regulators in this condition intervene despite hamster operating honestly, the risk take place in the terms of risk over regulations, risk of over regulation in fact. And this could lead to backlash from the industries and users who might perceive the intervention as excessive or detrimental to innovations. And final conditions for final players regulator take place here where intervene meet fraudulent operations. If regulator intervene upon detecting fraud, they can take legal actions to prevent further damage, and this strategy helps stop fraudulent activities, protect consumers, and maintain trust in the financial systems. Until this moment, we speak bit together about the different players in the Hamster Kombat cryptos, their incentives, and the payoff matrices. But we need to know about the probability estimations. In fact, the probability estimations is the most important part of this video that we discussed with together. What is the probability of the fraud estimations of hamster based on the payoff matrices? This is the issues that we will discuss it with together in the next video with together.